You buy a ticket, the plane takes off, and it seems simple. But if airlines maintain some of the lowest margins in the global economy, how does this industry generate billions? An airline is not just a transport service. It is a revenue optimization system managing thousands of expiring inventory. Units. You look at the flight board and assume the price of your seat represents a simple exchange of cash for a trip from one city to another. You see the crowd at the gate, the fuel truck connected to the wing, and the flight crew preparing for departure. So it feels like the profit must be the difference between your fare and the cost of keeping the jet in the air. Yet, when you look at the raw data, the math starts to fray. The global airline industry only generates a small amount of profit per passenger. In fact, that figure is forecast at $7.90 per passenger for 2026. That is less than the profit earned on a single mass-produced smartphone cover. If the margin on a seat is truly this thin, the core business model of selling transportation must be hiding something significant. If ticket sales alone do not explain how this industry sustains itself, what is the actual mechanism powering the machine? The standard narrative about filling seats to cover operating costs is only the visible surface. Beneath that, the numbers reveal a financial structure that relies on moving things other than just people and selling things other than just the seat itself. We must look past the departure screen to see how the industry turns a tiny profit margin per head into billions in total revenue. The economic product the airline is actually managing is not the trip itself, but the time-sensitive access to a finite capacity. Think of every flight as a temporary market that exists for only a few hours. Once the wheels leave the tarmac, every empty seat becomes a $0 asset that can never be recovered. This is why the industry operates on such narrow margins, balancing heavy fixed costs against the volatility of human travel habits. While you see a ticket, the airline sees an inventory of perishable units that decay in value every minute until takeoff. If a seat remains unsold at the moment of departure, its potential revenue hits exactly zero. This creates a relentless pressure to fill the aircraft at any cost, yet simply filling every seat isn't enough to build a lasting business. If the average profit is less than $8 per person, the survival of the airline depends on more than just the base fare. It requires a machine built to extract value from every inch of the cabin, every bag in the hold, and every interaction with the passenger. That search for marginal revenue is where the traditional airline model transforms into a high-stakes logistics and finance operation. This retail transformation is even more potent in the realm of virtual currency. That specific pursuit of marginal value exposes why every passenger is treated as a unique financial variable. An airline needs a combined net profit of $41 billion for the year 2026 to hit its targets, yet that relies on an average profit of just $7.90 per passenger. To sustain this, the math must work across several distinct layers at once. First, the cabin is divided into invisible silos, where the same physical chair is sold as an entirely different product depending on who is buying, when they booked, and how much they are willing to pay. Then, that headline ticket price is unbundled, stripped down, and rebuilt with layers of ancillary revenue. But beyond the cabin, the aircraft itself operates as a dual-purpose logistics vessel. Space in the belly hold is often the deciding factor that turns an otherwise marginal route into a profitable one, carrying high-value freight that can sometimes contribute significantly to the revenue on a single international flight. Every one of these components, the ticket, the bag, the seat upgrade, and the cargo pallet, must be synchronized in a high-speed balancing act. If the reservation system cannot manage this inventory with absolute precision, the entire operation drifts toward loss. But there is a massive problem. Airlines are still running this logic on top of legacy software stacks that are struggling to handle the modern digital load. We have to address how the airline actually calculates which passengers are worth the most to the bottom line before the door even shuts. That process begins with the most sophisticated lever they have, an engine of automated math that determines what every individual sitting in that cabin actually paid for their ride. That process begins with a calculation that runs millions of times every single day. This is the realm of revenue management, a sophisticated lever of automated math designed to solve one brutal problem: an inventory that loses every cent of value the moment the aircraft door closes. Airlines do not sell flights. They sell units of time and space that expire. To prevent these assets from hitting zero, they divide every cabin into dozens of separate fare buckets. Each bucket has a different price point, a different set of rules, and a different target. The algorithm predicts exactly how many passengers will try to book. At the last minute, how many will cancel, and how many simply will not show up. It then overbooks the flight to ensure the cabin is full, but not so overbooked that the cost of compensating bumped passengers exceeds the revenue gained from that extra seat. This is a continuous, high-speed auction where the price of the seat to your left or right is constantly fluctuating based on demand, competition, and the speed at which that specific flight is filling. The goal is to move the highest possible volume at the highest possible yield, wringing every dollar of potential profit out of that fleeting window before departure. But filling the cabin is only the first step. Once an airline has lured you in with a headline fare, the machine needs a way to turn that base fare into a much more valuable multi-layered transaction. If you look at the economics of a flight, the ticket is merely the entry fee to a captive environment where the airline controls every variable. They effectively run a mini economy at 35,000 feet. Once you are locked into that metal tube, the airline pivots from being a transportation provider to a retailer, extracting additional margin through a carefully tiered menu of options. They break the cabin down into invisible segments based on who you are, how fast you need to get there, and how much friction you are willing to tolerate. This is why your neighbor might be paying half your fare while receiving exactly the same amount of legroom. They are using fencing mechanisms to separate customers into different pools of profitability. A requirement for a Saturday night stay or a strict advance purchase window is not about scheduling. It is a filter. These rules are designed to lock in price-sensitive vacationers while forcing the business traveler, who rarely stays over a weekend, to pay a premium for flexibility. By the time they add baggage fees, priority boarding, seat selection, and those small onboard purchases for drinks or snacks, the base fare has been stretched into a much more substantial transaction. In recent reporting, these ancillary sales accounted for 15% of all global airline revenue, a historic high that reflects how deeply integrated these extras have become. Even with these add-ons, the airlines is still managing the passenger relationship as a secondary goal to the total volume of inventory moving through the network. But there is a massive piece of this business that exists entirely outside the passenger experience. It involves a high-margin product that never actually leaves the ground, even while the aircraft is climbing to cruise altitude. Selling miles to banks, credit card issuers, and retail partners creates a hidden economy that operates entirely apart from the aircraft. When a partner buys these miles to offer as rewards, the airline receives a massive cash infusion long before a passenger ever boards. While the liability for a future seat sits on the balance sheet, the liquid capital arrives today. This functions like an internal bank. A significant portion of total revenue comes from selling these loyalty assets, which provides a massive financial cushion during downturns, essentially turning every consumer credit card swipe into a direct subsidy. These partnerships also harvest vast amounts of behavioral data, enabling precision marketing that standard ticket sales cannot match. The cost of generating a mile is a tiny fraction of its retail value to the partner, effectively creating an interest-free loan from the customer base. This liquidity keeps the operation funded through lean cycles, yet it cements a permanent dependence on high-frequency spenders. The strategy relies on keeping the consumer trapped within a proprietary ecosystem, where the perceived value of the reward far outweighs the actual marginal cost to the carrier. But this loyalty machine cannot exist in a vacuum. It requires a constant, synchronized flow of assets to ensure the system does not break under its own weight. An airline does not optimize each flight in isolation to make this value extraction work. It must integrate these individual loyalty transactions with the physical reality of a fleet that has limited space and a rigid, interconnected route structure. If the network cannot handle the movement of these high-value passengers, the system of incentives begins to collide with the physical constraints of the aircraft itself. How does airline how does the airline reconcile these competing demands when one specific route is struggling, yet the broader network requires the volume to maintain its reach? This collision exposes the reality that a single flight is never a standalone transaction. The airline treats it as a single node in a massive interconnected lattice. To see the logic, consider that a route looking weak on its own balance sheet often functions as a critical feeder for profitable long-haul services. It protects a hub, fulfills corporate travel contracts, or connects dozens of individual journeys that would never exist without that specific link. Hub and spoke systems concentrate passengers from smaller cities into major transfer airports. This density allows the airline to fill more seats and serve more global destinations without needing to operate expensive direct flights between every possible city pair. Every route serves a specific, calculated purpose in the broader web, feeding higher yield passengers from regional locations into high-demand, long-haul corridors. Some airlines even rely on revenue guarantees from local entities, which commit to a specific amount of income for new services and compensate the carrier for any shortfalls to ensure the link remains open. Corporate travel agreements further complicate this, sometimes forcing companies to purchase a specified number of seats regardless of whether they are occupied, guaranteeing revenue even when a plane takes off with empty middle rows. But why would an airline keep a flight running if it cannot fill those seats with bodies? If a passenger light route still generates consistent income from cargo, that route can be more profitable than a full flight that carries nothing but people. The passenger cabin is only the top deck of the value proposition, and the math changes entirely once you account for what is being moved below the floor. This cargo leverage acts as a hidden stabilizer, separating the operational survival of the route from the volatility of ticket sales. Because the lower deck is typically underutilized on transoceanic routes, carriers treat this belly space as pure margin. A flight that appears lackluster on your passenger load dashboard often hides a high profit reality deep in the cargo hold. In peak conditions, this capacity accounts for a large portion of the total revenue generated on a single departure. It is why network planners will aggressively maintain a route that consistently fails to break even on passenger volume alone. By moving electronics, time-sensitive pharmaceuticals, and urgent machine parts, the aircraft justifies its own departure, regardless of how many seats remain empty in the cabin. The math shifts from selling individual travel experiences to maximizing the mass and volume utilization of a flying container. When belly hold logistics are operating at peak efficiency, the airline is effectively running two businesses inside one metal shell. One business manages the friction of human expectation and scheduling, while the other manages the cold economics of industrial logistics. Each unit of cargo acts as an insurance policy against soft passenger demand. Yet, this dual-layered revenue system relies entirely on the precision of the network. If the weight distribution or the scheduling alignment between the two streams drifts, the operational cost can quickly balloon. We have to address exactly how the airline measures success when these two revenue streams overlap, and why a full airplane can still bleed cash if the underlying unit economics are misaligned. An aircraft is an asset that only generates revenue when it is in the air, yet it burns through cash the moment it pushes back from the gate. To determine if a flight is actually profitable, airlines ignore the spectacle of the crowded cabin and focus on the cold math of unit economics. The primary metric is load factor, the percentage of total seats filled with paying passengers. But high occupancy is not the ultimate goal. A flight filled entirely with discounted fares can generate less total revenue than a cabin containing fewer higher-paying business travelers. The industry tracks two specific metrics: revenue per available seat kilometer, known as ASK, and its counterpart, cost per available seat kilometer, or CASK. The entire profit margin resides in the microscopic gap between these two numbers. If an aircraft is full, but the tickets were sold at rates below the operating cost per kilometer, the airline is effectively paying for the privilege of moving its passengers. Conversely, a flight that appears empty can be highly profitable if the passenger mix includes high-yield corporate travelers or if the belly hold is packed with premium cargo. This creates a constant, high-stakes balancing act. Planners must juggle schedules to maximize aircraft utilization, keeping each jet in the air for as many hours as possible. Every hour spent idle on the tarmac is an hour of lost revenue and ongoing depreciation that can never be recovered. This pressure drives the industry obsession with tight turnarounds and fleet consistency. Yet, even with perfect load factors and aggressive yield management, the business remains at the mercy of its cost base. Labor is now the primary operating expense, consuming 28% of total costs. Fuel remains the second heavy anchor, taking another 28.7%. Together, these line items swallow more than half of every dollar, earned before a single pilot even touches the throttle. To manage this pressure, airlines treat the operation as a high-stakes engineering problem. They prioritize fleet commonality to slash maintenance overhead, utilize dense seating to spread fixed costs, and enforce turnarounds measured in minutes. The faster an aircraft returns to the gate, the more revenue it produces before the day ends. Low-cost carriers ruthlessly strip the product to its barest bones to protect their margins, while legacy giants accept higher complexity in exchange for network reach and premium demand. This divergence defines the industry. One side bets on efficiency, the other on capturing high-yield corporate contracts. But every maintenance delay or ground handling bottleneck acts as a tax on these razor-thin margins. A single aircraft sitting idle is not merely a missed trip. It is a multi-million-dollar asset burning capital instead of generating it. Airlines collectively spend over $500 million every year on workarounds just to keep their legacy software systems functional. This massive capital drain reveals a dangerous truth. The model demands extreme precision to survive, yet it relies on interconnected systems, often decades old. The machine functions only when every part remains perfectly synchronized. But that synchronization is constantly tested by a world that refuses to follow a schedule. Airlines are fundamentally brittle systems. They operate at such high utilization that there is zero slack in the schedule. When an operational failure occurs, such as the July 24 global IT outage or the Southwest Airlines meltdown in 22, the result is not just a localized delay, it becomes a cascade. Loki. The Southwest failure cost $740 million, including over $600 million in customer compensation, and a settlement with the Department of Transportation. These costs are the hidden tax on complexity. Legacy reservation systems often struggle to handle rebooking thousands of passengers simultaneously when a hub is crippled by weather. Almost 50% of digital upgrades fail because new interfaces cannot reliably talk to the old architecture. When a system goes dark, the downtime can cost an airline up to $400,000 per hour. A single software update from an external vendor can cause thousands of flights to vanish from the board. Millions of passengers are stranded, and the financial impact ripples through every balance sheet in the sector. Because the airline business relies on this constant, high-speed exchange of inventory, a failure in the software is equivalent to a physical blockade of the runway. You end up with aircraft that are legally and operationally untrackable, crews that are out of position, and an inventory that simply ceases to exist. Once that happens, the machine cannot print money because it cannot move the product. When a system relies on such thin margins, the difference between a profitable year and a total collapse is measured in minutes of delay or fractional shifts in fuel costs. The business survives by scaling this thin margin across millions of seats, but it leaves almost zero room for error. The machine is essentially a high-velocity, high-risk engine that requires absolute operational synchronization to function at all. The real product being sold is the management of risk across a volatile, time-sensitive system. When an airline reaches out to capture that final sliver of value, they are effectively turning the entire flight into a multi-layered financial instrument. You are not just buying a seat. You are buying an option on a perishable asset that loses every cent of its worth the moment the cabin door seals. The base fare is merely the anchor for a massive, automated ecosystem designed to extract profit from the same asset multiple times. This is a precise optimization strategy. By the time you board, the airline has already used dynamic algorithms to fill the cabin, sold miles to banks to guarantee immediate liquidity, filled the belly with cargo to underwrite the route, and layered on fees to harvest individual surplus value. The network relies on the fragile connection between maintenance, crew scheduling, and digital infrastructure. When a weather event or a system outage breaks that link, the revenue stops, but the fixed costs, the fuel, the labor, the aircraft leases, continue to burn. The industry survives because it is built to squeeze value from every cubic inch of the fuselage and every moment of the customer relationship before takeoff. It turns the physics of transportation into a data-driven pursuit of incremental gains. The math is unforgiving, the operational risks are high, and the profit is rarely guaranteed. But for an airline, the mission is not simply to move people from one city to another. It is to ensure that by the time that airplane climbs to cruising altitude, every single seat has been optimized to produce the maximum revenue the system could possibly extract, and that is how the machine stays in the air. This video is for educational purposes and is not financial advice.